The currencies to look at are going to be those that are most closely linked to Chinese resources. Mike Jakeman, EIU. The manufacturing sector in the US has faced its fair share of difficulties in recent months, from low oil prices and a strong dollar. Mike, how closely should investors view market manufacturing PMI out this week?
So we're relatively confident about consumer spending in the US. I think it's fair to say that for a long time we've seen that the strong dollar and low oil prices are the two biggest challenges facing the US. And in a sense, the consumer sector has kind of helped to gloss over the weakness in those areas. The reason that we're still pretty confident about consumer spending in the US is quite simple, and that's because of the strong labour market. We're seeing that job creation remains well above 200,000 a month, which is kind of a benchmark for a good rate when you've got some slack in the labour market, which means that more and more people are getting new jobs, and it really follows that quite a lot of that money that they're going to receive from their new jobs is going to be spent. What we've seen is perhaps the savings rate has been a bit higher than perhaps we were expecting, which means that Americans are choosing to save the money rather than to spend it. But I think given the sheer number of Americans that are getting new jobs, it's a reasonably safe bet to assume that consumer spending is going to carry on growing.
Thursday sees the release of Australian consumer inflation expectations for January. Despite things looking optimistic for Australia, what impact has global events such as China had on the economy?
The single biggest trend in Australia in the Australian economy you've seen over the past 15 years has been this enormous amount of spending on the resources sector, particularly on coal and LNG exports. And as often tends to happen with these kind of large, long-term projects, you get the investment phase when prices are very high because companies are determined to get in on the action. And then by the time that these terminals and these quarries are actually exporting, you find that prices tend to fall again. And this is exactly what's happened with Australia. And the bet that they're making now is that the sheer amount of resources exports will mean that the country will benefit from selling them, even though the prices are a lot lower than they were hoping they would be.
Analysts fear a currency war may be around the corner, with the euro threatening to give policymakers an incentive to add monetary stimulus. What can we expect from the euro following the outcome of the ECB rate decision?
This is a really interesting one because when the ECB met in December, Mario Draghi had made some very strong signals that they were going to increase the amount of the QE purchases and cut the deposit rate. And instead what we saw was a very minor cut to the rate, and they didn't move QE at all. I actually think that they're probably going to carry on with QE probably for another year or so at the current rate. And then you'll gradually get, just as we saw in the US, those purchases will start to dwindle and be cut until they come down to zero, perhaps by the end of 2017. And then you'll get a pause, and then perhaps by the middle of 2018, we'll start to see the ECB gradually increase interest rates from the floor, which is exactly the pattern we saw with the Fed in the US last year. Of course, the problems with this, there are all sorts of things that could happen that would mean that this gets delayed a bit longer. So what does this mean in terms of the euro and the dollar? We think another year of a pretty weak euro this year, and then by the time you get to the point where the ECB is starting to prepare for tightening, we'll see that the euro starts to strengthen again against the dollar.
The S&P cut Poland's long-term foreign currency credit rating on Friday. The negative outlook from the S&P has caused the zloty to fall to a 4-year low. Are there any other currencies investors should keep an eye on this week?
Well, this week, for me, in spite of the Iran deal, which is very significant, the single data release we're going to be looking at most is Chinese GDP for Q4, which means that the currencies to look at are going to be those which are now the most closely linked to Chinese resources and demand for resources. So, for example, you're going to want to look at the Canadian dollar, the loonie, and the Australian dollar. And what's quite interesting is that both of these currencies have been losing a lot of ground against the dollar in the past 6 months, which makes sense because commodity prices have been falling faster and faster. However, I thought it was quite interesting that today China's trading band for the renminbi was fixed a bit higher, and that seems to have calmed markets a little bit, and we've seen minor gains for the Australian dollar and the Canadian dollar. So let's look at this Chinese GDP release later this week. I expect that it's going to, I mean, we always have a fairly good idea what's coming. It's going to be around 7%, and that will actually help to calm markets a little bit, because there's been so much worry about China in recent weeks. So a reasonable GDP number means that you'll start to see some of these currencies doing a little bit better than they have done in the last couple of weeks.
Well, Mike, thank you for your insight. Sam Meredith will be bringing you a closer look at China's GDP data released tomorrow, so be sure to click back. Goodbye for now.